Good evening, this is Doc Severson for the Theo Night Report for Thursday, December 7th. In today's video, I'm going to start out by looking at the S&P 500. We've got 4 charts now, so we've got 4 panes on the fractals. We've got the monthly, weekly, daily, and 78-minute charts here. Now, the reason I'm using the 78-minute chart on the end is because it is a factor of 5. So there's 5 times 78 in a daily session on the cash index. And so each of these are separated by a factor of 5 from each other. So we're going down to the smallest time frame here, the 78-minute chart, to show you something here. So what we're seeing is in the daily chart's been pulling down here lately. And what we're starting to see is potentially a higher low on the 78-minute chart. So there's 2 main rules in price fractals. First of all, the larger time frames dominate the trend. Pretty clear to see that when we look at the monthly and the weekly chart. However, reversals start from the inside out. And so even though we've had a little bit of a down, not necessarily a downtrend, but more of a downswing on the daily chart in the last few days, what we're starting to see is potentially a higher low here, so a bounce back up. Now, here's where things get interesting is if we see something like this, if we see a bounce back up in the next day or so here, and then that creates a lower high and rolls over, then we have a downtrend on the daily chart. Not just a swing down, but a true downtrend. What that will manifest itself in is an actual swing down on the weekly chart. And eventually what would have to happen is we'd have to see another bounce back up on the weekly chart and then a lower low for that to also manifest itself into a downtrend. So you can start to see how reversals propagate from smaller time frames into larger ones. Now, one of my assertions is that the price is very slowly, very deliberately going into corrective mode. What do I mean by that? Well, here's where we have a price going into just outright accumulation, right? So we're going into what I've talked about is euphoria, the euphoria phase where the slope goes nearly vertical. But what you'll also notice is the ATR, or average true range on a trading day, is starting to dramatically increase. So we were down as low as 9 points a day in the S&P just back in October. So just a couple of months ago, we were 9 points a day, extremely small range, very quiet market activity. And now we've about doubled that. So we're up to about 17 points a day of range, and it's dramatically different. It's actually quite a bit different trading intraday now. We're starting to see a lot more, just within the space of a day, a lot more movement up and down, two-way trading tape. Whereas before this, back in the summer and into the fall, all we would see is usually an initial push up and then basically 5 hours of nothing into the close. And now we're actually seeing a lot more intraday volatility. So again, one of the things that I always talking about is that things change from the inside out. You don't get sick all at once. It's just one virus which starts to multiply and eventually affects your health. Same thing happens at the smaller time frames. Eventually, smaller time frames show this volatility, and it starts to propagate and it starts to become more unstable. So this is what we're going to watch for here. We're going to watch for that transition into volatility in the near term. I believe there's a good chance that we'll see this volatility continue to propagate in larger and larger swings as we get closer and closer to the end of the year. There's more at stake every little piece of news that comes out, whether it's the jobs report tomorrow or a potential government shutdown or the Fed meeting next week. All of these take on greater and greater weight as we have all of these fund managers that obviously the most important thing in the world to them is their bonus. And this is where emotional decisions get made, and this is why emotions affect markets in ways like this. One of the trades that came out through our scanner today was FXI. So this is the China ETF, and this is a variation on Larry Connor's timeless strategy, where he would do this on the S&P only. So what we did was we took Larry's original work on the S&P, and basically the rules are very simple. You're looking for stocks above, or in this case, the S&P above the 200-day moving average. He was. And then the Wells Wilder RSI with a period of 2 is dipping down below a level of 5.0. So we've got that. We've got check, check. Now, one thing I wanted to do, in addition to that, to somewhat strengthen the signal and to make it more universally applicable to all stocks and not just the S&P 500, which is what Larry did, was also add our fractal energy study in down here. And then what I want to see is exhaustion to the downside. So now we have a high probability that this price is going to react back. I'm not looking for it to make new highs. I don't care about that. But the rubber band has been stretched very far in this direction, and I'm looking for some type of reversion back to the mean. So there's a number of ways that we can trade this. But my favorite is to go to the back week options, which in this case is 15 December, and then look for a very simple call spread. So just a simple debit call spread, which we could set up here. So like 44.5, 45.5, and set this up for less than 50 cents. We have a 1-to-1 reward to risk trade on this. And we're just going to look for a quick pop to the upside of about maybe 30% or so. This is a high probability trade that we've done well with over the course of the year. Okay, folks, that is it for tonight's report. Thanks for listening, and we'll see you tomorrow.